on the physical futures contract that there needs to be real concern about market concentration in that. With respect to the financial contract, I think, first of all, it's very hard to even define what open interest and what total financial risk exposure is on the financial risk of natural gas. And so to say that one participant is 30% of the open interest on the Intercontinental Exchange in a financial product, for December 2011, right, I think is largely irrelevant, given that that exposure relative to total risk in the market is very small. Second, I think I need to point out that the financial trading is the single most competitive market in the world. Right? It allows competition solely on the basis of price. The individual trading one lot is at the same playing field as ExxonMobil, trading thousands. Right? If the individual wants to be the most competitive buyer or the most competitive seller, they have that right. And I think you have to allow the market to make the decisions about who's the best buyer, who's the best seller, who provides the best product with respect to an ETF, who provides the best product with respect to index funds.
I thank you. I turn to Commissioner Dunn.
Thank you, Mr. Chairman. Mr. Arnold, in your written testimony, you're critical of the NYMEX granting exemptions and their ability to monitor that. Could you amplify a bit on that? And if, in fact, the Commission was to be granting these exemptions rather than the exchanges, what would you say we ought to be doing in monitoring these positions, these exemptions, and the directions that they're going?
So I think if I can comment on hedge exemptions a little bit broader, and that's, I believe that the 1,000 lots limit on last day in natural gas is enough for any foreseeable commercial situation. So if you start from there and say that no commercial necessarily needs more than 1,000 lots in the history. Right,
and your point was in your testimony that it is expanded to 3,000.
Right. People have hedge exemptions that allow them to have 3,000, 5,000 lots on the second to last day, third to last day. I think hedge exemptions on the physical futures contract is a Pandora's box. And once you open it up and allow one counterparty to have a hedge exemption, then it's hard to stop and not let much of the industry have hedge exemptions. I think they create volatility in the market because you have participants who are hedging financial risk and using physical contracts, and they're keeping these contracts off the market until the very end. Last day or last 30 minutes of expiry, and the market has a hard time balancing. It makes the market more opaque because the market doesn't know whether those contracts represent real demand for the physical gas or whether they just represent a proxy hedge for some financial risk. I think hedge exemptions are prone to misuse and abuse. I think the abuse is that they're granted for a one-year period based upon some claim that a commercial has in the market based upon that risk on that day. The NYMEX doesn't know, and I think it would be hard for the CFTC to know if the next day, if that risk disappears, should that hedge exemption still be there. I think they're very difficult to monitor in real time. I think it's misused because the industry continues to use the physical futures contract as a proxy to hedge financial risk, and financial risk is best used by the industry. Financial risk is best hedged by the industry using a financial product.
Thank you. Mr. Verlanger, in looking at your charts, chart number or figure number 3 in your chart is the one that I labeled "Wow," at a time when our cost of fuel, even diesel fuel, was going up. We were net. Yeah, you did. Well, I'm going to give you a chance to talk about it now.
Right.
At a time when diesel was very, very high here in the United States, we were exporting.
Yes.
Explain how that happens, and also the impact that the strength and weakness of the dollar has in this arena.
Okay. This graph shows by month data on net exports of distillate fuel oil according as reported by DOE, and it goes from 1990 through 2008. What you can see is there was a surge. The story began when Europe started to shift to ultra-low sulfur diesel in 2008. We had shifted in 2006. This is 10 part per million diesel. European refiners could not produce enough of it. The European refiners could produce gasoline. The European, and Total on its website has complained that the European government has pushed everybody onto diesel, but they haven't built the refineries to make the diesel. And so what happened is we had the capacity, demand was down here, as the witness from Schneider would explain, because the recession had already taken hold here, pulled it up. And what happened is the dollar went from about, I think it was 1.3 to the euro to 1.6 to the euro at that point in time. And of course, the marginal buyer of diesel at the time was the European consumer, paying in euros. So as the dollar strengthened, they were paying in euros. The dollar price of diesel has to rise, and essentially that sucked diesel fuel from the United States to Europe. If we believe free trade, as I do, that's the system's working. But that pulled things up, and it actually, what we saw was that because refiners couldn't take the sulfur out of crude oil, their desulfurization units were full. Essentially, all they could do was buy sweet crude oil. It happens that there's minor factoid is there 3 kilos of sulfur in a barrel of sour crude, about 100 grams of sulfur in sweet crude. So what you do is you go for the sweet crude. This is why I and a number of other people were trying to get DOE to sell sweet crude from the SPR during this period of time with the exports. That would have eased the situation. That would have stabilized the price. But this is the graph. I mean, I've been using this graph. This is the telling sign of how our trade patterns got distorted and why we were seeing such a pull on the price of sweet crude oil last May, April, May, June, and July.
Thank you, Commissioner Dunn. Commissioner Summers.
Thank you, Mr. Chairman. My questions are for Mr. Chambers, and I appreciate your views specifically on this as a user of the OTC markets. And when we are considering imposing position limits, what your views would be on how we would impose those limits on swap dealers and how that could affect your ability to hedge and how, we may look through or impose them on the commercial end users.
Well, we think that if position limits were imposed on swap dealers, it would have a very negative effect on Chesapeake and other hedgers. And it's not just whether you're long or short the product. They frankly make the market for us. Otherwise, we would have to pick up the phone and try to find somebody to enter into an OTC derivative, as you had to 25, 30 years ago. We need them to help make this market. It's the most efficient way. They help us find that efficient price. And if you take away their ability to do that, it'd be very damaging.
And so just to follow up, can we make a system work where we allow you, the commercial end user, to have a hedge exemption, even if you're going through a swap dealer?
I think that Chesapeake and other end users would definitely need the hedge exemption. We would argue that the swap dealers would need it too, to the extent that they're offloading whatever business we take to them and whatever business they offload to someone else. Admittedly, and for the reasons we think that speculation is a good thing, for us, is that they help make that market. And if they offload our exposure to a speculator, to us that doesn't negate the fact that they are offloading a risk, so they should be exempt.
Thank you. Mr. Verlager, in your testimony, I want to try to clarify what your views are on how we currently, the current system for accountability levels, for position limits in the last 3 days, the fact that we give hedge exemptions and no action relief to these index funds. Am I right in assuming that you think the way the current system works is what you would suggest?
Not entirely. I As I said in my testimony, as I try to work through this, and I'm not a lawyer, I think that there need to be some sort of limitations in the last three contracts. I picked the last three. I think it's important to work on empirically and test these. We saw in February and March very serious disruptions in the oil market when U.S. oil was rolling its positions. Now they've moved their positions and there's less impact. I actually think that I believe that there are other instruments that are more suitable for investors. I cut out of my section of my testimony discussion of the BP Royalty Trust. I've been following this for 20 years. It's a way that the investor can buy a piece of oil, and it's like a true asset where you have a flow of cash. The asset gives you a flow of cash. These index funds don't, and they bother me in that way. You buy a bond, you get a flow of cash. The BP Royalty Trust price is closely correlated with the price of WTI, so they can get the same exposure. And I think, to a certain extent, there should be some encouragement of organizations to create royalty trusts now. In Canada, we have a problem. I'm an American, but I teach up there. In Canada, they've decided that royalty trusts were costing them too much money, and they've limited them. But it's in a position, to answer your question on the position limits, I think that as Mr. Arnold said, that in the physical market, one wants to start imposing limits as these contracts approach delivery. And I actually am one of the few people around here who remember the Hunt Silver thing, and I was listening to Mr. Jarecki on his testimony. He's a historical person. And so, there are a whole series of things, and these are very complicated. And unless you get down into the nitty-gritty of them, it's very hard to come up with an exact prescription, but I think you've got to go that direction. The one concern I have is the banks, which are writing to Chesapeake and doing and have bundled this risk from all these different parties and take all these things. And I really worry about putting position limits on them, because then they'll stop lending, and that'll turn the lights out in Calgary.
Thank you, Commissioner Summers. Commissioner Chilton.
Dr. Verliger, I want to pick up on what Commissioner Summers was saying. Did you see movement in crude oil prices that you would attribute to the U.S. oil role?
Yes, I did.
Okay. Have you seen any impact? I know you're just talking about the final days here, and they changed their role to a 4-day role. But have you seen any price movement with other ETFs?
The U.S. oil is the only one that was so public. They're the largest. And for years I've been following what's called the supply of storage curve. It's an agricultural economics tool. And the spreads, and it went totally out of whack in Cushing, where it should apply in February, March, just at the period of time when they rolled. And so you could see it there. That was the one time I've really noticed it. But the thing is, I have no, I watch from Colorado or from Calgary, so I don't have the inside information on what's going on. And you hear all these anecdotes, and most of the anecdotes turned out to be wrong.
Yeah. Thank you, Doctor. Mr. Arnold, I'm going to pick up on another thing that Commissioner Summers started to ask about, but a little bit different. Do you have a position on the no-action process with regard to ICE Futures Europe and the NYMEX-linked WTI crude contract? What issues do you see being raised by continuing to allow those two trading venues to exist without hard position limits?
So as a user, I appreciate that there's competition between two exchanges, right? The problem with one exchange, obviously, is that they can charge monopolistic fees. So I certainly support two exchanges. I think that the presence of two exchanges is exactly why the CFTC needs to assume responsibility for much of the regulatory oversight. One exchange cannot do it on its own. And especially kind of this unique situation with this no-action letter where ICE has to follow NYMEX's regulations. Right? You get this strange situation where NYMEX gets to put regulation on their competitor. So I think CFTC needs to assume responsibility for much of the regulatory oversight that's now done at the exchanges, and and create rules that are good for the market as a whole.
I happen to agree with you. Would you have it be an aggregate hard position limit between the two exchanges? Would you have it be a percentage of open interest? How would you do it?
No, I support tighter limits on the physical futures contract, which is only traded on the NYMEX.
No.
Right? On financial positions, I don't think that there should be any position limits. I think
Okay.
they increase volatility. I think they reduce liquidity and increase the cost to commercial hedging.
Okay, all right. I have more time, a little more time. I'll try to get one more, and then I'll be done, Mr. Chairman. Mr. Chambers, and this is another one that may help our Capitol Hill colleagues that are here, because it's about OTC and not necessarily the position limits or the hedge exemptions, but this issue of standardization. I cannot quite wrap my arms around how that is defined. I mean, if it's only defined as what a clearing entity can make money on, then, you know, that's easy enough. But how would you define it, and don't we need to cover more than just things that are standardized? I understand what we were talking about earlier, about your concern about clearing everything, but this issue of standardization, have you thought about it any?
Absolutely. The standardization question is key for a risk manager, for end users, really any risk manager. Take, for instance, if Chesapeake issues debt that matures 10 days from this date, to force that to be standardized would immediately create inefficiencies in the hedge, because you're not for sure if there will be a contract specific to hedge that risk that you could put in a standardized form onto an exchange. That in and of itself creates problems from an economic offsets perspective as well as an accounting perspective. And while you, in some cases, you might very well get the economic offset that you seek, but you might not get the accounting you seek. So you're going to have near-term volatility in your income statement that could, quite frankly, be confusing to investors.
Thank you.
I'm going to allow myself a third round and any other commissioners that want it. I said I could do 3 rounds with any one of you. But Mr. Chambers, you said earlier that you currently have 10 to 15 counterparties, or if I could call them suppliers of risk management, which we call swap dealers. I suspect that you feel that that's a good thing to have them competing with each other, that have 10 plus competitors supplying you that risk management?
Absolutely. With the more suppliers we have to affect our strategies, the better.
All right. So that seems to be consistent with my earlier philosophy, that the more suppliers in a market, in this case suppliers of risk management, which we call swap dealers, is a helpful thing to markets and market liquidity. You had also said just don't set position limits too low. But if we set them in a way that would help protect that, you'd have 10 to 15 dealers, as opposed to maybe, as the automobile industry in this country, concentrated down to 3. And then we had a lot of foreign folks, but I mean, a lot of industries get highly concentrated, not just in the financial services field. Wouldn't that be beneficial to Chesapeake and companies like yours to continue to have a diverse set of suppliers of this risk management?
Certainly. The more participants in a market, the better. We're supportive of that. Our chief concern with using position limits to affect that is just we feel there needs to be more analysis and more data gathered to get the position limit right. That's where, going back to my previous statements, that is necessary to make sure that we don't get too low of a limit.
I understand, but when we heard from the swap dealers last week that they didn't want, one of them used, I think, the term splintering of markets, I just thought they just want to have a very large market share. So, and I would understand why. That would be counter to your interest. Mr. Arnold, if I can ask you a question about what we've proposed in over-the-counter derivatives. I know it's a little off the topic of your written testimony. But do you have a point of view, and if you don't, I understand, but do you have a point of view? We've called for the use of centralized clearing for standard product and the posting of margin Do you have a point of view as to the hedge fund community, whether they should come under that? We've heard from Mr. Chambers he thought that some corporate end users maybe would post non-cash collateral, but I was interested if you had a point of view of the hedge fund community participating in posting of collateral and whether that should be cash collateral.
Yeah, I think it's very natural for hedge funds to want to clear on the exchange to access the credit intermediation. I think hedge funds would rather pay a small fee to the exchange than take credit risk from accepting the swap dealer's credit, and vice versa, that the swap dealer is reluctant to take a hedge fund's risk. We don't have $10 billion of producing properties to set up as a reserve. We have cash that guarantees our trades. So that's why we clear 98% of our trades. I think it is important in order to maintain a vibrant market, to understand that people access the market different ways. Chesapeake accesses the market through the swap dealers. Centaurus accesses it directly to the exchanges. Some small speculators access it through the UNG or USO vehicle. But there are participants access the market different ways. But this commission should support this and allow this.
I thank you, Commissioner Dunn.
Thank you, Mr. Chairman. Mr. Chambers, you say in your testimony on page 6 that markets routinely overshoot when correcting for significant economic events, such as we've seen since the second half of 2008. Doesn't having passive investors in there exacerbate that situation?
I'm not for sure if I have all the information to answer that, but I was basing the concept of overshooting on really any market that sustains a massive downturn. Typically, the panic of unwinding your positions causes it to go past what some would call a fair value. So you do have investors jumping back into the market to get back to what could be accepted as a fair value.
But if you have an investor that is not reacting to market signals, doesn't that skew the market in some way?
If an investor doesn't react to market signals and is not analyzing the data, I think that would have an impact.
Mr. Verlager, you're looked up. Do you have a comment on that?
I think we've known for decades. I remember Keynes writing about how the market, just because the price may fall to, say, 50, maybe the right price, the price will fall well below it, which is why he wrote of the need for commodity stabilization agreements when he was coming up with the World Bank and the IMF. It's interesting that if you look at the data, what happened is that these index funds will reallocate, and I hope we get more data from the CFTC on kind of their actual positions, because you have to just approximate what their positions are in the oil community. They reallocate, so if oil prices rise relative to the other commodities in the funds, they will sell oil and tend to buy these other commodities. And so last year, as prices were falling from 150 down to 30 at the end of December, they were actually buying and buffering, and they were actually seen to be a stabilizing force. And I'm somewhat surprised to find that in the data, but it makes sense. And we heard from U.S. Oil the way they work. It also makes sense in terms of portfolio allocation theory. That is, the CalPERS or any of the other big retirement funds buying commodities may well, if they have a rational portfolio allocation, if they see something rise, energy, they'll sell those assets where they believe the price has risen too far to maintain a portfolio balance. So they can, again, this is why I have been on both sides of this issue. I think they actually are. The data seem to say that in the case of crude oil, and I won't say about anything else, they seem to have been exerting a stabilizing influence.
Thank you both. Again, Mr. Chambers, you go on to say that we believe all of this puts the CFTC and other regulators in a very difficult position. I agree with that wholeheartedly. But I'd like to get your thoughts, all the panel's thoughts on this, is that we're in a unique position as we look at the futures market and we look at the commodities that we oversee, and Congress has different entities based upon the jurisdiction of the enabling committees that also work in those areas. And in our case, it's FERC and the FTC and some of the futures on energy markets. What do you see the relationship between FERC and the CFTC ought to be in understanding the types of things that you've talked about on the supply that's out there, the supply that may be out there in a tanker somewhere that we can't see, so that we have a better understanding about storage capacity and what's really taking place and driving the market?
I'll go back to my previous statements that, you know, one of the reasons why this puts the Commission and regulators in a difficult position is just you have a lack of information. I think that information about physical and financial positions would greatly help out in making the appropriate decisions. I'll leave my comments at that.
In your opinion, is there a need for a greater communication between FERC and the CFTC, maybe even having joint meetings to address some of these?
It sounds like a good idea.
Absolutely. You also have the FTC with its new rules on what constitutes speculation. And you left out the Federal Reserve Board. In the copper crisis, I recall Mr. Volcker being over here kind of beating on the CFTC to try to get them to do something. In the silver crisis, not the copper crisis, in 1980. It's in my view that I've watched this debate between the CFTC and the FERC. The competence on markets is here. The experience on review of markets is here, whereas the FERC has the kind of the competence on the pipeline regulation and the storage. As for data on storage capacity and so on, I think it's essential that you share information and that there be much greater communications. But the competence on markets and market regulation is here. That's where it's been historically. That's where the experience is, and that's where it ought to be.
Thank you, Commissioner Dunn. Any other? Commissioner Chilton? I want to thank the panel. It was an excellent review. I actually was delighted to see that there's some commonality between a professor from Calgary and if I can, an investment or hedge fund manager in New York, right? Houston. All right, Houston. Now I have to know where you live. On possibility of setting position limits on the near months physical, I know. And thank you also, Mr. Chambers, for your expert testimony. We're going to take, I guess, because I know my commissioners, can we take like a 5-minute break, and then we're going to have Mr. Young, Mr. Masters, and Mr. Greenberger. Somebody who's not too far from the door to close the door, just so we can, that'd be helpful. I thank everybody. I want to particularly thank our third panel for their not only their expert testimony, but their patience. But we have with us Mr. Masters, Mr. Young, and Mr. Greenberger. And I'll just turn it over again, if it's possible, to try to give us the highlights. It was very extensive submissions, and it's all there in the record. But Mr. Masters, unless you want me to, do you want me to start with somebody else? I saw you with. All right. Why don't we just go left to right? And there'll be a little green light flashes at about 3 and yellow at about 4, and it gives you a sense of what Doug's doing over here. Oh.
Thank you, Chairman Gensler and Commissioners Dunn, Chilton, Summers, for the opportunity to be here today. I strongly recommend that the Commission adopt the following measures. Number 1, the CFTC should set aggregate speculative position limits that apply across all trading venues, including designated contract markets, foreign boards of trade, and the over-the-counter markets. Number 2, the CFTC should target an overall level of speculation in the range of 25 to 35% of open interest. Number 3, the CFTC should convene a panel of bona fide physical producers and consumers on a semi-annual basis for each commodity group to advise on position limits and the level of liquidity in the commodity derivatives markets. Number 4, the CFTC should set a super limit equal to 5% of open interest for any non-commercial entity receiving exemptions or engaged in spread trading. Finally, number 5, the CFTC should prohibit the strategy of passive investment. When I first testified in front of the Senate in May of 2008, I raised the alarm concerning the damaging effects of index speculation, and today I want to reiterate that all forms of passive investment in the commodities markets are a clear and present danger to the economy and American consumers. As I detailed in my written testimony, Goldman Sachs has said repeatedly that commercial producers were pushing down commodity prices through their hedging transactions. They took it upon themselves, without consulting anyone else, to create the long-only passive indexer. This artificial consumer was designed to add buying pressure to the commodities markets and to prevent prices from falling. This dramatically altered the structure of the commodities futures markets. In fact, this passive indexer has grown so large that their buying pressure has overwhelmed the selling pressure of commercial producers and caused commodity prices to increase dramatically and remain elevated for an extended period of time. The presence of passive investors has led to enormous volatility, which correlates with investment flows and has very little to do with supply and demand factors. There are 3 primary reasons why passive investment inflicts so much damage on the commodity markets. 1, it drives prices much higher as money flows in. Without passive investment, prices would be much lower. Why should consumers have to pay more for the essentials of life? Because of an asset allocation decision by investors. When passive investors allocate large sums of money to these markets, they do so with disregard for supply and demand fundamentals. Therefore, commodity prices reflect forces other than supply and demand. This destroys the essential price discovery function of the commodity markets. Because passive investors are long-term and they buy and roll their positions, they remove liquidity from the commodities markets. By consuming liquidity, they add dramatically to the volatility of these markets. This makes it much more difficult for hedgers to do their job and hedge. For these reasons, passive investment strategies in the commodities market should be prohibited. These markets exist solely for bona fide physical hedgers, and as much as investors want to take over these markets, nothing will change that fundamental fact. Capital markets investors need to invest in the capital markets, not the commodities markets. The idea of buy and hold in stocks is helpful, but buy and hold in oil and wheat is harmful. These are not just economic issues. In fact, they are national security issues as well. Today, the oil derivatives markets are inscrutable to regulators because of the bulk of trading that takes place over the counter. Therefore, it is quite conceivable that a rogue nation could use these markets to push up oil prices. This would cause tremendous damage to the U.S. economy. There are many important reasons why we need aggregate speculative position limits, but one in particular is to effectively deter our enemies' potential attempts to acquire large derivatives positions in our commodities futures markets and negatively influence the outcome. Having embarked on this set of hearings, the CFTC needs to take strong action to protect the commodity derivatives markets from excessive speculation. If it does not, then it will send a signal to Congress that strong additional authorities are not imperative. And it will send a signal to speculators that it is okay to push billions of dollars back into these markets. America has only one chance to get this right. It would be better to do nothing so that at least consumers are aware of the risk rather than implement half measures that have the appearance of doing something while in fact leaving our commodities derivatives markets open to fraud, manipulation, and excessive speculation. Thank you very much.
Thank you, Mr. Masters. Right in the time, too. Mr. Young.
I stand.
I want to push the button there.
Green.
You know that little pad? Well, that's called a button. Mr. Chairman, as you know, I used to work at the commission, and when I came back here a few weeks ago, people asked me whether there was electricity in the building when I worked here 30 years ago. So apparently I haven't caught up with the technology. Excuse me. Mr. Chairman and members of the commission, my name is Mark Young. I'm appearing today on behalf of the Futures Industry Association. One good thing about being on the last panel of the last hearing is that you know how the time limits will be enforced and you know how active the questioning will be. I've been watching, and I will try to be brief. FIA supports new authority and resources for the Commission. We support extending the Commission's transparent market surveillance and reporting powers to certain OTC and foreign transactions. We support changing the CO2 reports to make them more granular. We support granting the Commission standby position limit authority for markets that settle off the prices of U.S. futures contracts. Giving the Commission new tools does not mean we believe the Commission must use every tool it has in every way. Reasoned, balanced analysis should drive regulatory outcomes. That is why we are pleased the Commission has held these informative hearings. We also understand the Commission is updating its September 2008 report with new data. We look forward to public release of that report and hopefully to equally informative public hearings to examine its conclusion when issued. FIA's written statement describes our views on price discovery and position limits. As we explain, our major concern is market migration. If the CFTC imposes rigid position limits, we fear price discovery in U.S. markets will move offshore or to less regulated venues. That will compromise the Commission's market surveillance capabilities and our members' business. We know many do not believe this concern is real, but I am sure everyone would concede that the world has changed since 1936. Through technology, globalization, financial engineering, and the like, U.S. markets do not operate in a vacuum. We are part of the world. Last month, Prime Minister Brown and President Sarkozy warned of the harms of market volatility, but recommended more transparency, not position limits. If other regulators in other countries do not believe that position limits will help price discovery in their markets, we have to ask ourselves why. Is it because they tolerate price manipulation or market disruptions, or their market surveillance systems are better than ours, or their trading systems differ from ours? I think we would all agree the answer to these questions is no. This answer should give us pause. Unless regulators in other countries see position limits as a cure for their markets, FIA believes there is a real danger that imposing rigid position limits on U.S. markets will cause market migration. That shift would harm price discovery in the U.S. and the public interests the Commission and the Commodity Exchange Act serve. As our written statement makes clear, before imposing position limits, the law requires the Commission to find first that some level or form of speculation or speculative trading has caused or will cause price fluctuations and changes which are sufficiently unreasonable and unwarranted to burden commerce. Then the Commission must find that any limits it sets are necessary to diminish, prevent, or eliminate such a burden. At this point, we see no consensus, and based on the last panel, I don't see how anyone could see a consensus on whether the excessive speculation standard has been met. The Commission's update of its 2008 report will shed additional light on this important question. We look forward to reviewing it when it is available and to answering your questions today.
Thank you, Mr. Young. Mr. Greenberger.
Thank you, Mr. Chairman. I also, as an alumnus of the CFTC, want to congratulate you and the other commissioners on what I think have been 3 very excellent days of hearings and probative questions. I'm here today. First of all, I thank the chairman for inviting me, and I was asked by the steering committee for Americans for Financial Reform to speak on behalf of that coalition. It's 200 members. It's made up of the nation's largest unions, civil rights organizations, and public citizens groups. They have a call to action seeking financial regulatory reform. And last week they forwarded a letter to the Hill leadership supporting the Obama administration white paper proposal that standardized contracts be moved onto exchange trading, and that swaps dealers who have large volumes in these markets have their own regulatory requirements applied to them. For purposes of today's hearing, the Commodity Exchange Act of 1936 may be old, but it is still the act. It was proposed to Congress by President Roosevelt in conjunction with the Securities Acts of 33 and 34, and I think the SEC still finds those acts to be probative. I think the chairman in his opening statements has made it clear that you feel yourself bound to the statute as it now presents itself to you. Maybe it should be changed, but in this regard it hasn't. And you noted, Mr. Chairman, that where there's a potential of burdening interstate commerce and excessive speculation is found, position limits have to be imposed. That issue has practically been resolved for every market. Physical market, there are position limits for every market. It may be you set them or the exchanges you regulate set them, but they're position limits. Nobody's coming here and saying abandon the idea of position limits. Once you accept position limits, you've accepted the possibility of excessive speculation. Now, with regard to speculation, as my testimony points out, and I think as you've tried to point out, Mr. Chairman, there's a lot of confusion. The Commodity Exchange Act recognizes that speculation can be and is necessary. Physical hedgers cannot operate regulated exchanges on their own, and speculators, however they come to the exchange, whether as swaps dealers, individual investors, commodity index funds, may be needed to create necessary liquidity. Without the liquidity, there would be no exchanges. What the statute says is speculation is good when it creates liquidity. When it goes beyond that, it is excessive, and there have to be controls. The controls are position limits, and we have position limits today. We are bound by that statute in how to go forward. Now, there's a bona fide hedging exemption. Who is not going to be subject to the position limits? My reading of 4C is consistent with the purposes of the futures market, again, as evidenced what President Roosevelt wanted and what the agricultural committees did in 36. The futures markets are unlike the equity and debt markets. The futures markets are designed to allow people to hedge their commercial risk. That is their exclusive purpose. They're not designed to have somebody come in and look at a company and say, gee, that company is selling for a small price. I can make $100 million investing $1 million. The purpose is to allow commercial hedgers to hedge their risk. The tension between producers and consumers in the hedging process creates a reflection of supply-demand fundamentals. Futures markets are price discovery. Everybody accepts that. When you go to buy something in the spot market, you look to see what the futures price is. You are hoping and praying that the purposes of the Exchange Act are met by that tension of people who do care about what the price is, that it will be a reasonable, fair, open, orderly price. People are invited as speculators who, as the USFO person said, I don't care what the price is. Yeah, we want those people in to create liquidity. But if you have, as the Senate wheat report just reflected, 60% of the wheat market being speculators, you lose the supply-demand function, and consumers, such as those I represent, are not paying according to market fundamentals. They're paying according to people who don't care what the price is, except that it meets its betting strategy. You have the power to control that, and you should control it.
Thank you, Mr. Greenberg, Mr. Young, Mr. Masters. If I could start with a question for Mr. Young. Are you familiar with General Counsel Berkovitz's testimony to the Commission on our first day of hearing about our legislative history and background on?
I read his report. I didn't see all of his testimony.
Okay. Well, on that first day, I recall asking him, we could ask him to come back to the witness table, but if I can paraphrase what I remember asking him, was whether this commission had to find that there actually was as you just said, what I'm trying to say is he doesn't, I don't think, agree with what you said in your opening statement, that this commission does, under the Act, it says shall set position limits where necessary to eliminate, diminish, or prevent the burdens that may come to interstate commerce from excess speculation. So if we see those burdens in the future, it's not about saying there was something in the past. That's how I recall his testimony. We could ask him to come back up and see if that's correct. But do you agree with what I'm paraphrasing I think our general counsel told us?
First of all, I have great respect for your general counsel.
You might want to push the button.
I have great respect for your general counsel. You can probably show me how to use the microphone, and I'd be happy if he wants to join the discussion. I'd start by just simply saying, I agree with Michael Greenberger. You have to apply the statute as written. The statute says very clearly there are two components to the Commission's speculative position limit power. First, there is a finding of excessive speculation which has caused price fluctuations or price changes that are unreasonable or unwarranted.
The chair and asked General Counsel Berkovitz last week testified differently than that. I will.
If you'd like me, Mr. Chairman, I'll read you the first sentence.
No. I'm going to ask General Counsel Berkovitz.
Okay.
Yeah, why don't you? I mean, I'm sorry. Just grab a mic. I'm not going to do this long.
Yes, Mr. Chairman, last week